Alright, so welcome back to another video, and today I'm going to be going over a backtesting session where we will be basically counting and collecting data on how price interacts off liquidity sweeps. So to real quick start off the video, I hope you guys have already seen the liquidity sweep video. After seeing those sections, you should be in the last session here. I'll be including this video in the backtesting session, but if you haven't already, you guys know there's good liquidity sweeps and bad liquidity sweeps. And I'll mention those again, cover them real quick here in today's video. Bad liquidity sweeps are when they are counter trend, meaning if we're bullish on the higher time frame, right? If the external trend is bullish, meaning we're expecting our drawn liquidity also to be higher. So for example, let's say this is our drawn liquidity. We are expecting these to be breaks of structure externally. And you can also take counter trades when price is trending. It's just going to be lower probability, obviously, of course, right? And so the thing is, these are considered lower probability liquidity sweeps when you're going against the trend. So if you're taking this break of structure as a liquidity sweep, yes, I teach it as a break of structure, but you can also view it as a lower probability liquidity sweep. Then yes, this is considered, low probability liquidity sweep. But if you want to talk about high probability liquidity sweeps, that is when we go pro trend. So meaning if we're bullish, right? Let's say high time frame draw on liquidity is going to be showing us whether bullish or bearish typically, or based on price action in terms of structure. Let's say structure is very bullish on high time frame, and we do this. Something like this typically will become a high probability liquidity sweep. When price sweeps in the opposite direction of the higher time frame, most times it is just stopping out early buyers that have bought here to create likely either inducement. If not inducement, it will still count as a fake change of character to the downside if our draw liquidity is on the upside, right? Remember, there's a lot of manipulation going on when we're trading in the markets. So it's very important to understand the difference between lower probability liquidity sweeps where we're taking trades against the trend, overall trend, or higher probability liquidity sweeps where we're taking trades with the trend. So again, you can think of and imagine this also vice versa for bearish as well. You guys should be able to get the gist. But today, we're essentially basically backtesting how many more candles price takes after taking out liquidity. So for example, one real quick example is going to be this, right? Let's say this is a break structure. Now, obviously here, this is going to be a little complicated because you can see all this as higher time frame inducement because we still have a lot of stuff unmitigated here. And this is just a smaller pullback. But in this case, I'm going to be counting these as what we're going to be counting today because price came back and it reacted and held an inducement, creating a new high, meaning this is likely newer structure now. But again, this later on at some point will be a high time inducement to go higher if we have a higher drawn liquidity, which from my perspective, we do. So for this, essentially, we're going to be counting the number of candles that break after the liquidity sweep, and this is just to collect data essentially on understanding how far typically price goes when we're doing a pro liquidity sweep versus counter liquidity sweep, and as well as ways we can potentially try to capture like a bigger piece of the move when we're targeting highs or lows. So you guys know we usually target inducement, flips, origins, or external liquidity, which is swing highs and lows, right? And so this video is going to be more targeted towards the swing highs and lows because we're going to be finding ways to be able to target them a bit further and capture a bigger portion of the move. Because sometimes you guys notice if you're truly right on the expansion move to target a swing high that's weak or low that's weak, for example, in a continuation especially, sometimes price continues to go much further past the swing point. So today we'll be doing some data collection on that and whether or not that is true. I've already done my own backtesting to collect data on this, but I wanted to just do a session with all of you guys as well so that we can collect it and see it together, right? So we're going to be basically collecting mainly the median and mode in terms of statistical data today. So if you guys don't know what that is, you can look it up. I'm not going to go too depth into statistics here, but this is very, very basic statistics 101 that you should have learned in school likely, median and mode. Mode is the number of times a number appears, and a median is putting all the numbers in order from lowest to highest, and then selecting the number that's probably around in the middle. So that's what we're going to be exactly doing today. So how are we going to count these candles? Well, what we're going to be doing is counting candle breaks. So every time when we take out a higher low swing point, the candle that takes out the higher low is going to make a higher low, right? And we're going to be counting after the higher low of that breaks. So in this case, we're going to be counting this as one break here. So this candle here is going to be considered 0. And then this, as soon as this high breaks here, it will be considered 1. So this is 1. And then if this candle high breaks again, it will be 2. So in this case, we are going to be considering this is 2 breaks. Okay. Remember, the initial candle that breaks or sweeps does not count as any numbers. So it's 2 candle breaks occurring after we take out liquidity. That's how we're going to be viewing this today. So we're going to keep track of these numbers, and then at the end of this video, we're going to do a basic calculation. And again, I'm going to try to go over this data, as fast as possible here, so this video doesn't take too long. So let's calculate this right here. Sometimes we're gonna be looking at really like inducement. Sometimes this is inducement here basically for this demand here. And I think price is likely to not hold this here, but we'll see what happens here again. This does get a little complicated here in terms of price action. But we're gonna count this as well here. So this is gonna be 2 candle breaks to the upside as well. So let's just start doing this testing today. This right here is going to be, remember, the initial candle doesn't count. So this is 2 candles. We'll say 2 candles break right there. And part of my data collection that I've done already, I'm going to just tell you guys ahead of time. Most times the candle breaks are very small, right? You guys can notice a lot of times it's wicks. Like, except for maybe this one here, which is whole body. But most times when it breaks again, most times it's very small movements to upside. So this just shows us, after we collect the data on a number of candles that break after a liquidity sweep, if you ever plan on targeting, the higher low, always to make sure that you give basically a little bit more room. So for example, let's say we done our data collection here and we ended with a result that after doing this back testing, 2 candles break after. So we can estimate roughly how much more 2 candles is past the liquidity point. So we can roughly estimate, let's say here. And I'm not going to be doing percentages today, because another way you can measure this is based on percentage movements, like 0.02% of gold. That is going to be a different percent for every single asset. So unless you want to backtest every single asset, or maybe if you only trade one asset, you could just backtest that one asset. But personally, to make it more universal and easier, I like to go based on number of the candles breaks, because they're a lot more mechanical than a percentage, because a percentage can always change a lot depending on what price the asset is at nowadays. So far we have 222. Now again, here we have another break right here, another break right here. Again, these, like I mentioned, since if our draw on liquidity is higher, right, for this high, and high time frame structure is bullish, right, it's bullish, this is lower probability liquidity sweeps, right? Like if you're trying to short here, there's no confirmation here, by the way, guys. So you should not be shorting here anyway. There's no entry model there. But if you were shorting here, obviously you can see you take a loss, right? It's a lot more probable to trade with the trend here, right? And you get a better risk reward majority of times. And sometimes price will not fully retrace, and that's fine. There's nothing much you could do there. It's just better to wait for price to retrace than to take a FOMO entry at the top here, just like how you would if you did here and you just take a random loss here, right? So here we're going to be calculating number of candles here. In fact, I'm going to be putting numbers so it's easier. I'll use this version. This is going to be 1. This candle is 0. That's 1. And actually, you know what? This is probably going to show up worse. So we'll do 1. This here is going, let's see how many drawings I have. 187. Okay, we're good. This here is 0, 1, 2, and 3. But you can see the 3 is like a wick, right? It's a wick closure. So just keep that in mind when you're targeting and looking for targets, really. Okay, so let's now move on to the next candle right here. As you can see, my draw on liquidity is right now. I'm expecting us to take out this low, at least coming into this demand here. But anyway, let's go back to the point of today's video, obviously, which is to collect some data. And this is exactly how you would want to collect data. Now, this is not entirely backtesting here, because right here, the reason why I'm not doing candle bar replay mode where you can't see the future is because it will save us a lot more time, because we're not backtesting a strategy right here. We're just backtesting how price moves. And if you want to backtest how price moves, you want to see the entire context of price. So hopefully that does make sense to you guys. If you're backtesting a strategy, definitely do not do this in hindsight. You want to be doing it candle by candle. So here you can see likely continuation model right here, right to the downside. Drawing liquidities on the downside, and you can see this is going to be 0, 1, 2, 3. 3 candle breaks, but you can see how these candle breaks are much bigger. These are full body candle breaks, right? The displacement is much larger. So depending on how you want to collect this data, I'm just going to do it for you guys today. But again, that could also vary, right? Like this is one candle break, but this is a way bigger move here. It's a way bigger move here than the one candle break mentioned, right? Even here, this is 2 candle breaks and it's a way smaller move, way closer to the swing point than this one, right? There's a lot more displacement when you're doing trading continuations. That's why when you're trading continuations, sometimes what I like to do is, especially if it's a really high probable continuation and not price ranging, you can target a little bit further past the swing point, or even look to the left and maybe you can see, oh, aha, we have like a flip right here. We could target here past the swing point. Sometimes you might not be able to. You don't want to target too far because let's say you enter here. I don't know. Just take it. Let's say you take a short here. You don't want to be maybe targeting too far here because price could definitely, reverse on you. And typically it won't take out this high because you expect this high to be protected or strong. But again, you never know, right? Price could do the liquidity sweep and then continue. So make sure you still have conservative TPs. Don't have too aggressive TPs whenever you're trading, especially if you want a higher win rate. So here is one right there. What is this? This is going to be just one right here, and it's going to be a wick closure one. And move on to this. I feel like I've done a video backtesting this liquidity sweep candle count thing, if I'm not mistaken. But again, I'll probably go back and check, but we'll do it again anyway. So 1, 2, 3. This one's going to be a long 4, 5, 6, 7, 8. 9. Yeah, this is going to be out of the range of data. So this is going to be like an outlier. I'll just put 8 here. And usually for the outliers, we do not care, right? So like numbers like this are going to be filtered out when we calculate the median or mode anyway. So this doesn't even matter. This is an outlier. We would like to see and look for at the average of our data. So this here is actually 0. Okay, so this is 0 because the candle that breaks, like I said, we don't really count. So it's just 0. And basically what happens is, I'll show you guys later how you can use this data properly when we're targeting highs or lows, if that's what you plan on doing, like trading continuations. This here is going to be 1. And we did not take out that low. This right here is going to be 1, 2, 3, 4, 5, 6. Basically here is going to be hard. I'm not going to count all the way up here. But basically here, we never have an entire pullback enough. So it's just a continuation here. I'll just put 6 for now. But again, that's why we're not calculating the mean. We're calculating the median for a reason, right? So these outliers get, highlighted. And I won't be counting these because you likely won't be trading off there, targeting that. This low never got taken, so won't be calculating that. This high here is really like just inducement here, honestly. So I'm not going to count that as a swing point that breaks. And sometimes I will be marking like inducement here, guys. I'm just saying, majority of times I'm just marking whatever I see that's most obvious. Like this high is obviously liquidity being taken, right? But obviously as in a continuation, and you can see we actually tapped into this supply right here. So the objective of this likely got met, and that's why this low actually became weak at that point. We can anticipate it to become weak. Originally it was strong, but we can anticipate it to actually change to a weak low if we did meet the objective here. This is gonna be 1, 2, 3, 4, 5 candle breaks right here to the upside. This right here is one candle break to the downside. This again is really inducement here, so I'm not going to count that. But we did tap into, you obviously take out inducement, tapped into supply. I'm just going over real quick, just like, again, how you guys can read price again, just because. Let's see if there's anything else here that I'm missing, really. And one more thing I forgot to mention is there is such thing as overfitting at a certain point in data collection, and that's why a lot of people like to collect a large number of sample trades. And that's what I'm trying to say is basically if price is like fundamentally trending a ton, and technicals would show that as well. So like if gold is trending heavily, the candle breaks would likely for liquidity sweeps would be likely a lot more than if we're in ranging conditions, because ranges typically would reverse back to the mean pretty fast, or the basically the middle. So yeah, that's another thing to keep in mind. But today we're just to be doing, again, like I mentioned, a rough session on just counting the number of candles that break after a liquidity sweep. Again, it's not extremely important, but this might be important for people that want to just, learn roughly how far price goes after taking out a swing high or low to determine whether or not they want to take either reversal trades or have farther targets when they're trading. Like for example, this is a 0, this is 1, 2, this is a 2 candle break after the initial candle, but you can see this is a much bigger move, right? So you're going to have to be able to roughly either estimate, place your TP a little bit further, or what you do is you just have to wait and count to yourself the number of candles that break after if you really want to catch the main part of the move. Again, we're just trading off probabilities, right? If the average becomes 2, sometimes you could get, like I mentioned, we saw earlier, 0 candle breaks, and you will just not be able to catch you would just be able to likely hit break even at that point. So again, there's definitely a lot of things to keep in mind here. This right here is going to be 0. So again, it's all up to how you want to trade, how conservative or aggressive you are when it comes to trading. This is 2. This is going to be a higher probability liquidity sweep, like I showed you guys. Remember, if price takes out a swing low and it's kind of trend, it's a lot higher probability. So this would be a high probability setup right here, taking this OB entry model right here, and you can target the weak high, for example. And that was actually the wrong tool. Yeah, it's a long position. So it'd be something like this, essentially. So this is right here is 2. If we take this out right here, again, also different assets might be a different number of candle breaks. I don't know. I'm just sure certain assets will have a bit more than others. So again, try to, if you're going to do backtesting, do it on the pair that you trade the most. Or maybe the pair you only trade. It's up to you how many pairs you trade. Recently, I've been focusing more locked in, mainly on just trading gold. And just gold and ES. That's about it, really. I don't trade oil as much anymore, and Euro USD. And it's due to like the lot size stuff, but not just that, but also there's just, I'd rather focus on a few more because I'm currently trying to also do a bit of my own testing to try to optimize my system a little bit better, because I believe there's always some type of room for improvement to an extent, right? You don't want to be overfitting your trading data. That's the bad part, but you do want to be optimizing to have a good system. So right here is 0. This would be 0, 1, 2, 3. This is where it gets kind of complicated because there's a complex pullback here that's a fake out right here, right? Making a fake change of character. Would you really count these extra candles here? Would you really be holding through all this? That's another question you have to ask yourself. You have to look at how price is reacting. Will you really hold after seeing price react like this, making a fake reaction? Are you able to hold through that? If not, you don't want to count all those candles. So I would say you're up at 3. And you can see continuations can be very far, right? This is probably like 10 plus candles right here. I'm just not going to put in the data collection because it's not going to matter anyway, since it's overfitting, or not overfitting. It's going to be outside of the sample range, really. So it would get removed anyway. We have 1 here, roughly. This is 0. And we have, I'm not going to count that right there. This is 0. And this right here is 1, 2, 3, 4, 5 roughly. And then when we take out here, I'll say this low is the most prominent, since we took out this low here actually as inducement to go higher. So I'm actually going to be counting this here, and it'll be 1, 2, 4. This right here will be roughly 1, 2, 3, 4, 5. And again, if it's too many candle breaks, you don't even need to count it for data purposes. There's no point. It's just going to be obviously way out of the sample anyway. This is 0 right here. And again, it depends on how many trades or how much time you really want to backtest this on. You can see so far we're only 4 days back, and we have so much data collected already. And also depending on session, right? You also want to be backtesting the session you're trading. The averages for number of candle breaks after liquidity sweep might be a little bit different per session. So you do want to also backtest this. Like for example, I would count this personally as 0 just because I'm likely to not hold through all this all the time. Sometimes you just have to look to the left. Like if my draw liquidity is here, it's already got hit. I'm likely not going to hold through this complex pullback right here. So I'm going to put that as 0 there. And again, like I mentioned, how you collect data here is how you want to be trading and how you comfortable you are in holding longer or shorter trades, and be able to manage your emotions when it comes to fake reactions in the market, which I made a video discussing about fake reactions in the market. This is one. Let's see. What else do we have here that's clear? This right here is pretty clear to me. And I'll count this as well right here. This is 0, 1, 2, 3, 4 roughly. This is 3, right? Because likely, are you really going to be realistically holding through all this? If you have a very clear draw on liquidity like this, then yes, right? I will be. Otherwise, you can expect price can even potentially come all the way back to your entry, hit you out at break even, mitigate your entry, because there's something left unmitigated when you enter a trade, and come back up again. So I'll keep at 3. And we're not going to have time today, honestly, to be backtesting several assets. Again, this is just I wouldn't say a very important backtesting session. This is just for people that want to optimize liquidity sweeps and just collect some data on how much more price really moves when it does these sweeps, right? This is probably going to be the last day I'm going to be doing here. I don't want to make this video too long. And we also need time to real quick just calculate the data. So here is going to be 1, 2, 3. Here is going to be 1, 2, 3, 4, 5. Around, I'll say 5 roughly. You don't have to be too specific here. Again, it's going to take out the big numbers on the high or too high of an end or too low of an end anyway with the median and mode. This is going to be 1, 2. Oh, this will be 2. This will be 0. This will be 1, barely. And we'll do this as the last one right here. This will be 2. Okay, yeah, honestly, this was only like 7 days of data, but we do have a lot of numbers we can add here and put together, obviously, into the calculator. So let's see real quick. I'm gonna remove this real quick, and I'm gonna pull up the calculator so we can see basically the average, not the average, the median and the mode. All right, so to end off today's video, after doing the calculations, you can literally do it yourself, or you can pull up a median and mode calculator on the internet. After putting in the data set of all these numbers, I've ended off with these results. The median is 2, and the mode is also going to be 0 and 2. Both of these numbers appear 9 times, which is the most frequently out of the other numbers, and the median is 2, and this clearly matches basically the exact same results I had when I was backtesting myself the other day. But when I was backtesting myself, the mode was 0, but again, 2 was very close to second in terms of the mode of how frequently it appeared. So you guys can see, just based on this, you guys will know now roughly after a liquidity sweep of whether that's, again, pro trend or counter trend, a low probability liquidity sweep or a high probability liquidity sweep, you can expect a median of either 2 or a mode of 0 and 2. And personally, I'd say to stick with the mode. I think the mode is more important because you want to see what happens more often than not when it comes to trading data, right? So I'd say the mode is what you should be using, honestly. And because the median does filter out the highs and lows of percentiles, but again, mode shows what occurs most frequently. So you can just stick to this theory that after your results, statistically, this is our findings. After a liquidity sweep, whether that's pro or counter trend, price will do a candle break either price will either have no candle breaks. The candle itself that takes out the high or low will start the reversal in price internally, or price will do a 2 candle break after the initial candle. So this is going to be our findings. This back test, again, this could vary slightly based on the asset you're trading as well as market conditions, but that's why we do take the median and mode to take the best numbers that we can get. And so this is our judgment here that we can just based off today's back session. This is like a 25-minute back testing session, which isn't long at all. But for a video, I don't want you guys to be sitting here seeing me mark up this stuff when you can do it yourself as well, just to see it for yourself. But again, this is just something you guys can utilize in your trading in the future in terms of what type of data you want to collect in terms of how price moves under the asset of your choice. So for example, if now you know that when you're trading, if you want to maximize and you're trying to target the high or low, for example, and remember, make sure your drawing liquidity is correct. If it's wrong, then don't target the high or low. Target something more that's more obvious in terms of it could be either the flip or the origin mainly is what I would target if I'm not targeting the high or low, right? But if you really wanted to maximize, let's say your trade here, let's say you were expecting continuation or expecting a weak high or low, right? To really maximize your trade, what you would really want to do would be, instead of having your TP set, you can either, at the high or low, you can either set your TP slightly above the high or low to expect a 0 candles break after the high or low, meaning the candle that breaks will have likely a wick, right? Most times it will be a wick that takes out the high or low and then immediately reverses. So to maximize the most out of your trade, most times you can stop your TP slightly just above so you can capture that wick movement, because if you just wait for the candle, sometimes you won't be able to capture it. And same with the 2, right? If you're using the mode of 2 as your data collection, you can wait. What you do is you wait for 2 more candle breaks to occur and then you exit at the second candle break. Essentially, we can either wait for the second candle to close or try to capture the momentum of the second candle, whatever you prefer to want. But again, like we did from our back testing, most of the times if it's a counter trend, lower probability liquidity sweep, it will be likely a wick that breaks, or it could be very tiny, right? So in my opinion, best bet really, unless you're expecting a very big continuation, you have a lot of confluences adding to it, like your drawing liquidity on the high time frame is a lot higher, you're sure that liquidity has already been taken, or you tapped into the origin and that's just not inducement. If you have all your criteria met and confluences met, then yes, you can theoretically just have either, you can trail your stop loss even, but I don't trail my stop losses in this situation because most times you'll get a fake out candle that hits your stop loss just to continue higher. So I like to read based on, like I said, number of candle breaks. Or you just hold to your TP if you have a further TP on a higher time frame, like a high timer flip or origin, maybe on a 1 hour, 30 minute, whatever you want. But again, most times price will reverse a bit again to do the continuation, and it could hit you out break even. So I try not to do that often unless I'm very, very confident. So again, best solution for me personally for this is just set your TP. If you're gonna target a weak high or low, just have it a little slightly above so you can capture the wick movement. And if not, basically capture the 2 candle breaks. And after that, you can expect price to reverse on you and just don't hold past that essentially. So that's basically gonna be the gist of today's video. Hope you guys did take a lot out of this. I feel like this was a very important video to make. Just for those that really want to optimize their system. Again, it's not important if you already have your system down and you have maybe, let's say, a 1-to-1 target system or something like that. But other than that, again, that's going to be the gist of today's video, and I'll see y'all in the next one.